I am Diana Dakika, Build It Green. I will be the webinar moderator today. Before we begin, we'll go over a few housekeeping items. I do apologize for any technical difficulties that we had earlier. All attendees have been placed on mute. This webinar will be recorded. If you have a question you would like to ask, please go ahead and type it in the chat box. We will answer your questions during the end of the presentation. If you're having trouble seeing or hearing the webinar, please let us know. If you're experiencing an echo and are using audio through your computer, you may want to try calling in again using a landline telephone. Our webinar presentation today is about multifamily energy efficiency financing for market rate and affordable housing. The webinar will cover the financing products and strategies that will help unlock emerging opportunities in California. We will discuss utility incentives, energy efficient mortgage products, and promising new loan products for multifamily energy efficiency. Our speaker today is the Multifamily Program Administrator, Corin Crawford. Let's all welcome Corin.
Thank you, Diana. Good morning, everybody. We're sorry for the technical difficulties that were experienced before, and I'm just going to jump right in. You can see on the title of the presentation, it's regarding all things multifamily energy efficiency finance. We're really going to kind of set the stage with why it's important, what's currently available, and what's down the road. So the key takeaways from today's webinar, as I said, are going to be, we're going to start off with why it's important, why it's important for a consultant's business, for a contractor's business. What's all of this talk about multifamily energy efficiency finance about? Then we're going to go through an overview of just the financing sources, and I'll contextualize it as to what's currently here, what's established, and then what's emerging, what's coming online that you can look forward to down the road. And then we'll end the presentation with a few strategies for new and expanded business opportunities, understanding the kind of content and lessons learned around some of the financing products that are available and coming online. So from an agenda, the 4 sections of the agenda pretty much follows the key takeaways. So financing in general, what's this all about? It can drive demand. Typically, what we've seen through surveys, through administering multifamily energy efficiency programs, and paying attention to the industry in general, is that high upfront costs of paying for a rehab or a retrofit of a property is a major impediment to doing energy efficiency. And so through surveys, we've learned, and through just our outreach with property owners, that readily available financing or sources of capital, be they utility incentives and or financial products like loans, grants, bonds, those sorts of things. While not a panacea, there isn't one silver bullet solution towards really jump-starting this industry, but with available financing, many more multifamily owners would pursue a rehab or an energy efficiency retrofit, a scope of work that involves energy efficiency improvements to a building. And that financing can drive that demand. So some key issues to know. Generally, as we stated before, properties just need capital to fund and overcome some of the high upfront costs that they're facing. Currently, financing is a major driver in the low-income or affordable housing sector. Many of the financial products have criteria that tie in energy efficiency into a scope of work, into financing, and that's a major driver. And the need is to not only diversify a suite of financing products that work for the affordable housing industry, but also to create similar drivers for the market rate sector. The multifamily building sector in general, as most people on the phone know, is it's a complex market. There are a whole variety of different building configurations, ownership types, and that a whole suite of different financing options need to be available to suit a whole variety of needs within the marketplace. So multifamily financing is a lot like commercial financing, where you deal with a property owner, property managers, you're dealing with investors. It's very different than your smaller scale, single family or duplex type of energy efficiency or rehab scopes of work, where you're primarily dealing with a homeowner, an owner-occupant of a property that makes investment decisions beyond simply, what's it going to do to the bottom line of my business. But in the multifamily sector, you're dealing with commercial, for the most part, commercial financing product types to an ownership that is more geared towards investments and making financial decisions based upon economic concerns. Within that ownership structure, you have multi-level, multi-party decision-making. So in the case of pursuing a rehab, a lot of times you have a whole panel of investors, or you have a board of directors, or what have you, upon which decisions are going to be made. So the decision-making process is a lot more complex. It might be more time-consuming and or sophisticated. A lot of times, these decisions are being made using more sophisticated financial analyses, using pro formas, discounted cash flow analyses, cost-benefit scenarios. When you're packaging either a rehab or a retrofit for a large multifamily building or a portfolio of multifamily buildings, the level of rigor for how that analysis is going to happen is going to be a bit more sophisticated, and the ownership structure and entities who are going to be evaluating it can require that level of analysis. And then lastly, this is the last point of this slide, which is very similar to, it can be similar to the single family or smaller residential sector, is that oftentimes you have, especially in affordable housing, you have a financing stack. You have multiple forms of finance. You might have a first mortgage. You might have tax credits. You might have supplemental loans. You might have, a whole variety of financial products that get cobbled together to make a project workable. And so that array of financing associated with many multifamily projects requires a whole set of approvals to get deals done. Within the multifamily space, we often like to identify the target audiences. And the players right now that we see in energy efficiency and rehabs and retrofits for, their buildings are really categorized into, as you've heard us say before, the affordable housing sector and the market rate sector. As I was mentioned before, in affordable housing, you typically see deals that get done and financed leveraging multiple sources of public funds and private capital. You see tax credits, bonds, subsidies, community development, commercial loans, a whole variety of financing products that get grouped together. Within the market rate sector, you're going to see two different types, subsets within this sector. You're going to see what we call your mom and pop owners, for lack of a better term. That would be owners that might own one building. They might own 2 or 3 buildings. Sometimes those buildings are 10 units. Sometimes they're 50 units. Sometimes they're 30 units. And the decision-making process when you have a singular owner or a family that owns 1 or 3 properties can be simpler. And typically what we see is that this type of owner does need financing guidance. They are financing their buildings with commercial finance, and yet they themselves might not have an established business entity with the administrative capacity to learn about all the latest financing vehicles available and process a whole variety of different financing applications, which is different than what we would call corporate scale or institutional scale owners. In those cases, what you're talking about are large regional property owners, real estate investment trusts, that have financing from institutional sources. Institutional just typically refers to financing sources, that where they like to transact business in a $50 million, $100 million increment. So we're talking about large portfolios, large buildings. 50 units is kind of small in this type of space, where you typically see building owners who own 80, 100, 200, 500, 10,000 units. It really runs the full gamut. But buildings themselves tend to have somewhere between 80 to 200 units themselves, and sometimes you'll see complexes that have, your 500-unit complexes and 800-unit complexes. So an overview of the types of financing products available, and I'm kind of providing sort of some generalizations for the types of finance that are available, typically that you see, within just the investment markets, but also these are types of products that are available for energy efficiency. You will see unsecured loans, and an unsecured loan is collateralized by the borrower's credit worthiness. So it's like a credit card. They might look at your credit score, they might look at your balance sheet or whatever, and it's a loan that is not secured via deed of trust against a piece of property. It's just based upon your company or your personal, or sometimes a combination of the two, of your credit worthiness as determined by credit score and financial capacity. We haven't seen a lot of unsecured loans in the multifamily space, but you do see energy efficiency finance in an unsecured fashion for the single-family space, but that doesn't mean those types of loans aren't being considered for what might be considered multifamily. In the case of this presentation, multifamily is a building that has 5 or more units. So if you had an 8-unit building, it might stand to reason that these types of products might be available, now or in the future. Secured first loan, that's a mortgage, first deed of trust secured against a piece of property, and a secured second, we call these supplemental loans, second loans, third loans. Sometimes you see a lot of layering in financial products. And so the novel financial products in general, from high level, from a characteristic standpoint or classification standpoint, some of the more novel products being developed include, utility on-bill finance, utility on-bill repayment. You see loans and payments based upon tax assessments and credit enhancements. And so, some of the details within that, within the on-bill finance space, the loan comes from the utility, and the loan is paid back via a tariff placed on a customer's utility bill, which is distinct from on-bill repayment, where the loan funds come from a financial institution, and via an arrangement with a utility, that financial institution places or the utility places a loan payment on the utility bill of that customer. And so with on-bill repayment, the utility bill is used as a vehicle for paying a loan originally issued or originated by a different financial institution, as distinct from financing where the funds come from the utility. So many people have probably heard of PACE loans, property assessed clean energy, where the loan is sized based upon the property tax assessment of the property and the general equity position of the building, and payments appear on as part of your property taxes. So it's a different means in which to size a loan and pay on a loan. And credit enhancements. Credit enhancements, we'll get into more detail down later in the presentation, but credit enhancements are essentially a way to what is called de-risk a financial institution's loan with help from other sources, other ways in which to make a loan less risky or more secured. So we've pretty much covered the first takeaway, why multifamily energy efficiency is important. We feel that financing should be an integral part of a rater or an energy consultant sales and marketing process because it essentially drives demand. There are lots of properties, lots of capital sitting on the sideline right now. Energy efficiency in general is a pretty hot topic for, throughout all property types. And people are really looking at, ways in which they can crack this nut for really unlocking a lot of capital and a lot of participation in the multifamily sector into, energy efficiency rehabs. And helping owners secure utility incentives and financing to cover 100% of the cost, because that's essentially what we're talking about with combining the utility incentives, which are available, the rebate programs, with financing to cover 100% of your costs, and have those costs, and have the payment be offset by utility bill savings and operating costs. So next we'll go into a bit of the established financing programs. And as I indicated a bit earlier in the presentation, affordable housing has pretty much led the way, where you have low-income housing programs, low-income housing financing programs that have established energy efficiency criteria. So the sources of funds that the affordable housing sector is used to leveraging to either acquire and rehab properties or build new construction. This isn't really about new construction, but the sources of funds that affordable housing uses to do business and acquire new properties and rehab those properties nowadays have either energy efficiency criteria attached to them or boosters, sort of added incentives, added points, added attractiveness of the project if you consider energy efficiency, water efficiency, green building designations as a part of it. From a federal standpoint, and with funds that trickle down to local community development finance institutions, the Affordable Recovery and Reinvestment Act, or Affordable Investment for the ARA funds. I'm forgetting the acronym. It'll come to me in a second. But the stimulus funds stimulated these programs between 2009 and 2012. And as part of the stimulus package in 2009, you had HUD that was allocated a source of funds, and HUD then distributed those funds to, as we talked about, CDFIs, Community Development Finance Institutions. I think it stands for American Recovery and Reinvestment Act. And at the state level, you have state housing finance programs that have also greatly contributed to energy efficiency finance via tax credits, and the California Housing Finance Agency has loans that are a part of the California General Fund that have energy efficiency, water efficiency, green criteria attached to them. And so generally, market rate housing needs convincing. We do see participation from market rate buildings in the energy efficiency space, but for the most part, they are taking advantage of utility rebates, and they combine those with their traditional sources of finance, be they reserves or other loans that they get through their established banking relationships. And so the new and innovative financing programs are distinctly aimed at creating more demand in the market rate sector and continuing and growing the participation and relationships in affordable housing. So some of the established financing programs that we've seen, again, since 2009, you have the HUD Energy Innovation Fund, and those are ARA-based funds. HUD created the Green Retrofit Program, Neighborhood Stabilization Program, programs that funded and required green capital / property needs assessments. These funds, these HUD funds, as I kind of alluded to before, are appropriated to the federal government, and then they're dispersed to CDFIs for a local face, local underwriting standards, local underwriting practices, key relationships with community groups. And so in California, we've seen Enterprise Green Multifamily Retrofit Program. Enterprise Communities is a CDFI that has a whole suite of services related to affordable housing finance and tax credits and the like. And then the low-income investment fund also has a program that they've leveraged our dollars to finance multifamily retrofits, multifamily acquisitions that had energy efficiency scopes of work attached to them. State financing programs. The traditional state financing programs, as we've talked about before, low-income housing tax credits, so the Tax Credit Allocation Committee, the California Debt Limit Allocation Committee, California Housing Finance Agency, Housing Community Development Department. These are all state programs that provide financing via debt and tax credit equity to multifamily properties, and they have energy efficiency criteria attached to them. So in terms of what's currently here, in summary, predominantly low-income housing programs with energy efficiency requirements, federal funds available, state funds available, and in addition, we can't forget about the utility incentives. And so while they're not per se financed in the sense of a debt instrument, they're grants, ratepayer-funded grants, essentially. These rebates we do see are a huge driver for market rate and affordable energy efficiency projects. So what's to come? What's emerging? So in general, here's a list as to the kind of the high-level categories of the types of programs and financing vehicles that we would say keep an eye out for in 2014 to 2015 and 16 and the like. I mean, I think that it's a really dynamic market space right now. So each year there will be more finance products and more types of programs that you see. But right now, these are the ones we want to talk about in terms of what you can expect to see being piloted and coming online in the next, say, year to 3 and 4 years out. So on-bill financing and repayment. These are, and we can, you can generally see what's up there on the slide there. These are, and we explained it a bit before, but they're loan programs for all property types, not just multifamily or residential. You've got on-bill repayment types, many commercial and industrial types of properties, where the loan and the finance is in some way tied to or repaid via partnerships and agreements with utilities. So with on-bill finance, the local utility makes the loan to the property owner, and with on-bill repayment, another financial institution makes the loan, and the utility collects payments on their behalf. So with the kind of the key benefits to utility on-bill mechanisms is that it's non-recourse finance that's not secured by the property. When we say non-recourse finance, that means, and the way that they're generally envisioned is that, non-recourse finance means they can't come after the project sponsor. They can't come after, an individual owner or an individual company's balance sheet is not on the line. The company's assets aren't on the line. The loan is made on the basis of the economics of the property itself. And then, the financing is not secured by the property. The idea is that with debt collection, financing and or debt collection in the case of on-bill repayment associated with a utility bill, that will provide the type of collateral or an added level of collateral that financial institutions need to see in order to make the loan. And so there are two types of programs associated with this at the moment. There's the IOU statewide commercial on-bill financing right now for commercial meters and multifamily common areas. These programs, there's a SoCal Gas on-bill finance program that is advertised and up and running, and some points in time or another, they had funds that they were actively financing projects with. It's a program that's up and running, but we categorize it as emerging because these are things that are just getting started. They're being piloted. They had limited pools of funds. We expect to see these programs play a larger part of the financing landscape for energy efficiency, and then in this year and 2015-16 down the road. And there's still a pending CPC financing decision for a non-bill repayment pilot for master metered affordable housing, which was expected to be approved now and or in the near future, but there was a recent CPUC decision and or notice that said that they've delayed it, and so the financing pilot is not going to be launched probably until the beginning of 2015. What they have done is they've allowed a pre-pilot, as it's called, to test the on-bill repayment financing mechanism in a program that's being sponsored by the California Housing Partnership Corporation, and that's a limited pilot for 5 buildings, and they are still getting that project up and going, but that's something to be very excited about. And so Fannie Mae has, we call them the Fannie Mae Partnership Programs, but Fannie Mae has 2 programs that are up and running in various parts of the country, and these are, again, emerging financing products that are currently doing outreach. They're gaining market traction. They're gaining uptick in participation. Kind of the key benefits of the Fannie Mae programs are that they actually have finance that underwrites energy savings into the loan amount. So, when you underwrite a property, you typically have an estimate of operating costs, and so those operating costs are kind of based upon a regional estimate as to what various properties in, say, Southern California or Northern California or New York or wherever it may be, what their operating costs are going to be. But those are typically, they don't factor in energy efficiency into those operating costs and the reduced cost that energy efficiency would gain. So the idea is that with reduced operating costs associated with lower the utility bills, you'd be able to attract more loan funds as part of it. You just have more net operating income. You have more profit, essentially, to work with, more cash flow to work with lower operating costs. And so most financing doesn't factor in these projected savings into their underwriting formulas for calculating your loan amount. But the Fannie Mae partnership programs do, which is a good thing. That's something that's, from a policy standpoint, something that people have been saying financing products we're hoping that they will do. Right now, the Green Refinance Plus program is available nationwide, and a new program called PEER is really, I think they've only launched one in New York City, but that's an initiative that I know that Fannie Mae is looking to expand. A little bit more about each of these programs. Again, as I said before, Green Refinance Plus program right now is available nationwide. It's available for affordable housing only, and it comes in the form of a first mortgage. And a first mortgage that has first deed of trust on the property. It's for acquisition rehab deals of existing multifamily, and as part of that, you get up to 4 to 5% additional loan proceeds that you use for the rehab portion. At the minimum, you use for the rehab portion for your new project, and those get directed toward energy and water efficiency improvements, not just energy gain. The PEER program stands for Property Improvements for Energy Reduction. The New York program is called Empire. It's, a play on words for the Empire State. The PEER portion of it, or the Empire portion of it, uses the same letters but it has a bit of a different translation for that acronym. But essentially, the difference between the PEER program and the Green Refinance Plus program is that these are funds that, like Green Refinance Plus, give you additional 4 to 5% loan proceeds based upon the value of the property for energy and water efficiency. But it's available to both market rate and affordable. And within the program, you can do first mortgages and supplemental loans. So the supplemental loan will be a second position loan behind a first mortgage that can be used just to do a retrofit as opposed to a full rehab of an existing building. I think it's right currently the regulations for the PEER program is that the first mortgage has to be a Fannie Mae mortgage, and that they're not going to place this supplemental loan behind any loan product. But again, these are emerging programs that we expect to see rolled out in California and other parts of the country as the years go by, and we'll see how their financing terms progress. Commercial PACE, and this is a program that we've probably heard about. PACE was really of interest for the whole market a few years ago, especially when we were looking at trying to extend PACE financing for residential properties, your single-family homes or your small 2 to 4 unit properties. Right now, commercial PACE is available. The Federal Housing Administration denied utilizing PACE for residential loans. But key benefits of PACE are that this, again, is non-recourse financing that's tied to property tax as opposed to utility bill or as opposed to the first deed of trust secured against a piece of property. It's tied to your property taxes, and the loan is based upon your tax assessment, and the repayments are tied through your property tax payment. So it's sort of like a tariff or an additional ad valorem tax that is tied to your property tax bill. And the financing stays with the property after the sale. So it's a financing product that spreads out the term of the finance, where a lot of commercial supplemental loans will be short-term loans. They'll be 5 years, 7 years, 10 years. And so if you have to repay a $300,000, $400,000 loan or $200,000 loan in 5 years, your monthly payment's just going to be real high. And then, that's just not going to be all that attractive from a monthly, annual cash-on-cash standpoint. But another benefit of PACE is that because it's tied, in a pretty senior position to your property tax that you have to pay before you pay, your debt, or you just kind of have to pay property tax. It allows lenders to extend the term of it to, say, 20 years, or that's how it's originally envisioned, so that your payments, you amortize that loan over 20 years, your monthly payment or your annual payments are going to be a lot less, which then makes it more attractive from just a revenue-generating standpoint. And then with an extended loan period like that, other concerns were, are mitigated by the fact that the financing stays with the property. So multifamily owners like to own a property typically for 5 to 7 years, 10 years, but if you have a piece of finance for 20 years, they might be reluctant to take on that finance because they don't expect that they will own that property for 20 years. But in this case, that's not so much of an issue. So those are some of the benefits of this. And California First is a group, an initiative that has made PACE financing for commercial available in the state. And they are, again, getting up and running and looking to increase their participation. Credit enhancement. So as I mentioned earlier, credit enhancement is a method where a company, an investment attempts to improve its creditworthiness, either via the debt creditworthiness, its balance sheet creditworthiness, and through a credit enhancement, a lender is provided with additional assurance. They have additional reassurance that the borrower is going to honor the debt obligation or the financing obligation through additional collateral. So that additional collateral might be in the form of insurance. You can get energy efficiency insurance. That's a form of credit enhancement. You can get a third party to guarantee. That's a credit enhancement. But basically what it does is these additional forms of promise on the loan, the different forms of collateral on the loan, reduces the default risk of your debt, and it thereby increases the credit worthiness of your financial product. It will help to lower interest rates and things of that nature. And so various credit enhancement programs that we see are loan loss reserves. These are perhaps a government will through the ARA funds in the past in New York. The whole Empire program in New York was created with a certain amount of money that was allocated to be a loan loss reserve that would then be pledged to in partnership with the finance institution. So the finance institution says, okay, we're going to loan on some of, we'll provide a certain pool of funds for energy efficiency. We feel like it's a riskier deal because it's a new kind of uncertain new market, but we have this additional loan loss reserve fund that give us that added security, so we'll take the risk. Co-financing is a more general form of, say, a loan loss reserve, or you might have two financing institutions come together and they'll provide loan funds together. So you might have a state agency that will say, okay, we're going to put 25% of the loan proceeds together, and we'll package that with 75% loan proceeds to with a financial institution, but the financial institution gets to collect on the full payment or the full amount of the loan. And then there are other types of products that we'll talk about, and I think the next one is one of them. So the Pay for Success program is a lot like a credit enhancement, but it's one that people are being that there's a lot of interest in at this point. It's an emerging public-private approach where private capital takes on the initial risk of funding energy efficiency projects, and that private capital essentially de-risks a deal, as it's called. So Pay for Success is really a contracting relationship between a government entity or a nonprofit entity and a lead contractor, and basically it's a contracting relationship that says that the government entity will pay for or take out the private capital. Private capital fronts the money. The energy efficiency program is performed adequately. It shows that it's going to produce the energy savings that you desire, and then that contract then steps in and says, okay, I'm going to pay for a successful project, and the government program or the nonprofit program has another source of funds that they use to take out the private capital. Those other forms of finance that take out that can be social impact bonds. They can be qualified energy conservation bonds. A QECB is a form of finance that has been approved at the federal level that allows the local government to issue bonds based upon energy savings, and so that's a form of finance that can be used as a takeout mechanism for the private capital. So you have a Pay for Success program that typically is a local nonprofit or a local entity that sets up a program. They pool funds together. They find a source of private funds, and they find a source of takeout finance, and they administer the coordination of the private capital that comes in, front-leading it, and that de-risks the outcome for the takeout finance. And the takeout finance is much more, they can go to financial institutions for the takeout finance, because the takeout finance might say, okay, great, we're not going to front load any funds here. We're going to take out the funds that way. So there you have your emerging financing programs. Lots of new programs and concepts. A lot of outreach efforts underway for market rate and affordable, and we really need to prove these concepts. to acquire better data to unlock huge forms of, huge amounts of private capital. But that's the general theory that's at play right now. All right, so I don't have much time, so I'm going to finish with a few strategies for more business opportunities. So overall, during a multifamily building life cycle, there are specific times when it's most cost-effective and convenient for a property owner to make energy improvements. And these are the ones that typically we see, from rehab to retrofit to equipment replacement, unit turnover. And what we see is that it's far easier to make energy efficiency improvements when a building is refinanced or sold and they attach a rehab scope to it, or equipment is being replaced, and that equipment, by virtue of that equipment being replaced, it's a good time to look holistically at a more defined energy efficiency scope of work where you can get utility incentives and maybe finance to do it. And so the strategy here is to think about replacements and upselling that into a retrofit, and or targeting buildings that are going to be sold or refinanced, and they might do a rehab. And an energy efficiency retrofit is a subset of a rehab scope of work. So some key opportunities to keep in mind are to build relationships with property owners and to do research with property owners that are thinking about purchasing or refinancing a building. There are third-party data sources that you can look at that have information on what buildings have recently sold, or the age of different buildings, different maturity events on financing of different buildings. And so those are some key opportunities to keep in mind. And then you have equipment replacement, HVAC, boiler systems, those sorts of things, water heaters. And so, beyond that, one can think of plug-and-play energy efficiency, where landlords are just too busy or reluctant to enter into the whole, maze of utility programs, financing programs. And so raters, or energy consultants, are a perfect business model to play the role of an owner's rep or an expediter, where you have a whole suite of services that you can offer to basically take the administrative burden off of a property owner, and pulling together incentives and financing and project management to offer plug-and-play energy efficiency is a good opportunity to expand your business. And then beyond that a bit are energy services agreements. And so an energy service agreement is where a rater, teams with a contractor, and in some way they provide a performance contract, or they go into a performance contract with an owner to essentially provide one-stop services, where they guarantee energy savings and they line up the contractors and the analysis in order to get energy efficiency done. And so right now, we see that the energy service company, the ESCO business, has been very successful, or there's been a fair amount of business and industry created in what is called the MUSH sector, and which stands for municipal university, or municipal MUSH, municipal university schools and hospitals, that's grown to be a $8 billion business a year for that market segment. And right now, people have been trying to figure out how you can create an ESCO-like model for the commercial multifamily sector. And so overall, summary of some of the strategic opportunities that I've just discussed would be to target sales and refinancing transactions, to partner with commercial HVAC contractors, to become an expediter, owner's rep, where you package financing and incentives and you guarantee savings or monitor utility costs, and a little bit of an adaptation of number 3 would be to look at adapting that ESCO model, a performance guarantee, an energy services agreement / contracting model to commercial multifamily. So that is it. And I know that we don't have much time, but I'm happy to answer some kind of key questions that have been generated from this. And if not, then if we don't have enough time for that, then we can follow up with some of the unanswered questions via email.
Yes, so if you have any questions, please go ahead and submit them in the chat inbox, and we'll try to answer a few of them with the limited time that we have available, but we will follow up to your questions via email and telephone as well. We did receive a question earlier just to review information about utility incentives. Can you please go over that again?
Sure. So utility incentives, currently you have, for in a multifamily context, you have utility incentives that are available. I guess the original source of funds would be the California Public Utilities Commission, which, via, the public goods service charge, they've allocated ratepayer funds to fund incentive programs sponsored by both utilities, investor-owned utilities, and local governments via the regional energy networks. And so in Southern California, you have the Southern California Regional Energy Network. You have SoCal Edison and SoCal Gas. You have SCG&E. And those are those are kind of the key incentive programs that are, just off the top of the head right now, that are available for multifamily. And these tend to be, whole building utility incentives. You also have other programs like the ESA program, Energy Savings Assistance Program, which is for low income, and it's called the Direct Install Program. It provides single measure rebates for different, kind of one-off energy efficiency improvements, being changing out lighting or changing out shower heads. There's Multifamily Energy Efficiency Program, MFER, that also is a single measure program that provides direct incentive amounts for various measures, changing out windows, changing out HVAC, and the like. So the ones that the utility incentives that exist for Southern California would be Energy Upgrade California, the whole building energy efficiency offered through the regional energy networks and the IOUs down south. You've got ESAP programs through utilities. You have MFER programs with utilities. And those programs are going to continue. These are, the CPUC has indicated that these are market transformation programs that are going to continue to be available. And, I know that they've just extended it to the end of 2015, and all indications show that these utility incentives are going to remain for the foreseeable future. And then, similar type of programs and incentives are available in Northern California. PG&E, the Bay Area Regional Energy Network has a similar suite of incentives that are also available.
And we'll be sure to follow up with this webinar with an email of links available and case studies that you can utilize for your information as well. Thank you so much for everyone for attending, and thank you, Corin, for this informative presentation. If anyone has any questions, please go ahead and email us at socalraters@builditgreen.org, and we will follow up with your questions. This webinar will be saved on the Build It Green website for future access. I will also email you a copy. We have another multifamily-related webinar scheduled on March 11th about how to market energy efficiency programs to clients. I do hope you can join us for that. We will be hosting a free BPI multifamily training in Southern California in Costa Mesa next month. Feel free to share the invite with your contacts. I will also include that in the follow-up email that we send to you today. I will email you more information about upcoming trainings. Have a nice day, and thank you for joining us.